In this update, we investigate 5 key themes across Australia's 5 major states with the help of the September quarter national accounts. We begin with the biggest surprise from the September quarter national accounts, which is the very weak consumer. Notably, this was actually the weakest quarterly outcome we've seen since the GFC and left per capita consumption growth below 1% for the year, which is obviously a very weak outcome. Quite importantly as well, we saw weakness across the entire nation. And so not only were the mining states weak, but equally the areas where we're seeing particularly strong population growth and also income growth, being New South Wales and Victoria, also saw very weak outcomes. It's really being driven by, I guess, a number of key themes. First and foremost being weak wages growth, secondly being the high level of household debt, and also the rising costs of life's essentials, particularly electricity at the moment. Residential construction has been a significant support for growth in recent years, but now that boom is ending. And indeed, we expect we'll see it actually take away from growth in 2017, 2018, and in 2019. Now, what's quite important to note, I suppose, as to the outcome we saw in the September quarter was not only was new construction down 1% for the year, but renovation work was actually down 5% over the year. This second outcome around renovation work really points towards a growing level of anxiety towards housing amongst households. They're becoming more reluctant to spend on upgrading their homes or expanding those homes to meet their current purposes. This really highlights the impact of weak wages growth and high levels of household debt, but also concerns more broadly about affordability, which is impacting the sector at the moment. Increasingly, there's cause for moderate optimism around business investment. This is because the decline we've seen in mining investment in recent years has largely run its course, and equally now we are starting to see momentum pick up in non-mining investment as well. The strength we're seeing in non-mining investment has been quite concentrated in non-residential construction. This is due to the need for greater supply or capacity in offices and also health and education, as well as new hotels being built in our major capital cities. Obviously, this has been quite a key positive, but if we are to see business investment really add sustainably and materially to growth going forward, we need to now see equipment investment start to accelerate. At the moment, that's being held back by the cautious consumer, and this is really a risk for the outlook. Government investment has been one of the most notable positives to the Australian economy in the recent past, and particularly for the major states of New South Wales and Victoria. This is because the investment that is being undertaken is really tied to population growth and also to the tax receipts being received from the very strong housing markets in these two states. This combination has really put them by and far and away above all the other states in terms of both the current outcomes and also the outlook. While we have seen some momentum in South Australia and Tasmania, the pipeline that is in those states is much weaker than for New South Wales and Victoria. So they're likely to see growth at a much more modest pace going forward. Queensland should receive more of a benefit in coming quarters, albeit at a more measured pace as well. The mining states, or WA and as I mentioned Queensland, are being to a degree left behind versus the southeast states. Finally, we turn to net exports. Now, while this particular part of demand was actually neutral for GDP in the September quarter, it is still a very strong underlying support for the Australian economy going forward. For commodities, we have seen commodity prices remain more elevated than we had expected, and because of the high quality of Australian exports in this space, they remain in very strong demand across the world. Equally, what we're seeing around the services space is that we are continuing to see quite strong demand for our tourism and education exports and also business services, which is really tied to the strong growth we're seeing in the Asian region. As we start to see a weaker Australian dollar over the next year or so, that should provide further support. So that combination should see net exports continue to add to growth over the next couple of years. Following these accounts, we continue to believe that GDP growth will remain about 2.5% through 2018 and 2019. The biggest risk really is around the consumer and its implications for spending by households as well as the housing sector itself. The biggest opportunities really are around investment and also net exports. We'll see you next week.